Hit it.
It's Friday, February 25th, 2022, episode 170. I'm Patrick Ceresna.
Let me do it again. Patrick sounded funny anyways. I was thinking about it.
Okay.
Leave this part in. Let's go. Hit it.
It's Friday, February 25th, 2022, episode 170. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we have the great pleasure of welcoming to the show a man of many talents. Jay Newman has been a developing markets debt trader for Lehman and Morgan Stanley. He then spent the next 2 decades working at Elliott Management, being best known as the hedge fund manager who chases deadbeat countries for payments on defaulted bonds. As for the next stage of his life, Jay has written a fiction book, Undermoney, which is part James Bond, part Liar's Poker. After that is Talking Charts time with Patrick and his crayons.
And then we end with our segments of No Stupid Questions and Skin in the Game. And, well, folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer am I drinking this week?
So today you're drinking AMO Brewing Company's Andorina European Pale Ale.
Very well done.
I don't know if that was proper pronunciation. But.
So
Do you know what? I'm sure it was because I don't even know what letter it started with.
Oh.
So I found this nice little microbrewery here in Lisbon. I'm taking off. This is my last week in Lisbon for now. And so I wanted to try this microbrewery. And they have an actual IPA that's one of their popular ones. But I wanted to try something different with this European Pale Ale. Let's see what this is like.
Yeah, tell us what it's like.
Wow, it's very light.
Oh,
It's it's like, yeah, it's light. It's
funny when the fourth one feels like that, right, Patrick?
yeah.
Okay. Lena, why don't you tell us about merch store and also about next week?
So if you are a big fan of our show, or if you have somebody else that's a big fan of our show in your life, please check out our swag at markethuddlemerch.com. There's true huddlers that are wearing our Market Huddle t-shirts on the beach. If you haven't seen it on our Twitter, please go check it out. Also, just a housekeeping note, we will be skipping next week due to travel conflicts. But we will be back the week after. So.
Right. And Cuppy will not be on next week, so it'll be the following week. The Cuppy's Corner will be delayed.
Yes.
All right. So let me do our side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include a scrambled goocher, advanced index life support, and vexatious vicissitudes. Oh, I'm really proud of myself. I got that one out.
The scrambled goocher is one that's gotten me all week. All right.
It's our pleasure to welcome to the show Jay Newman. Jay was a former hedge fund manager, and as he described to me, he was best known for chasing deadbeat countries like Argentina. And after that, he's had a second coming of his career, and he's actually turned into a fiction writer. So it's our great pleasure to welcome to the show, Jay.
Kevin, it's really fun to be here. Thank you for having me.
So I've been looking forward to this for a while because you wrote this great book. It's called Undermoney. And not only is it fiction, but it's fiction kind of up our alley because it's fiction that is based upon hedge fund managers. And not only that, there's a huge Russian component, which is all the more interesting given the developments recently. But before we get into that, I'd love to get a little bit of how a former hedge fund manager ends up being a fiction writer. So let's start from the beginning. You know, where did you grow up? Walk us through your career path.
I grew up in New Jersey in a family that really believed in travel. We traveled a lot every summer. I guess our most adventurous trip was my parents driving us from New Jersey to Nicaragua. My mother had read about the newly opened Pan American Highway and decided that it actually was a highway. It actually wasn't a highway. This was in the 60s, but we got there, we got back, so I'm here to tell about it. But
were they school teachers? Was that why they had the whole summer off?
My dad was a small businessman. He had retail stores, and my mom was a teacher. Yes, she was an art teacher.
and they took you off. So they decided that, most people drive to Disneyland or something like that, but you decided to drive to Nicaragua.
Absolutely. And it was probably the last time in history where you could do that without getting killed, because we drove. Imagine today driving through Mexico, right, or Guatemala, or Honduras, or El Salvador. Even then in the 60s in Guatemala, there was a guerrilla war going on, and we were stopped periodically by government troops and guerrilla groups, which were basically kids with machine guns.
Wow.
But they didn't know. Yeah, they didn't know. I mean, I was 10 years old. What do I know? But they weren't interested in us, so they just waved us through every time. But in between, they were fighting amongst themselves. It was, in retrospect, scary, but in the moment, it felt kind of normal. I mean, with your parents, you assume that's the way things are.
And were your parents just driven by desire to expose you to different parts of the world, or were they just adventuresome, free spirit kind of individuals?
More the free spirit, particularly my mother. My mother was also a writer, and she did a lot of writing and research on indigenous arts and crafts. She had a passion for it. She felt that, which I think has been the reality, that the traditional crafts of harvesting, dyeing, weaving, carving, all the traditional things that people did when they were, kind of pre-industrial societies, were going to disappear. And so she collected a lot of art and artifacts and wrote about it.
Oh, that's fascinating. Okay, so you grow up in this free-spirited household. You're driving to Nicaragua. Eventually, you graduate from high school. Where do you go off to school, and what are your ambitions at that time?
Well, I went to Yale and studied economics and history of art. I spent a year in London doing not much of anything for my junior year, which was, probably one of the best years I can remember. And I didn't have any particular. I thought I wanted to go into business in some way, but I didn't really know, the how or the why or anything about it. And in the end, I ended up going to law school, which was a mistake that took me 5 years to rectify, not including 3 years of law school.
Oh, wow. And why was it a mistake?
It just, law was not for me. I think it's, for better or for worse, I think it's a field where you're not often as self-actualized as you are in business, and where you have a pretty much blank slate and lots of different areas you can delve into.
Right.
So anyway, I really hated it.
Okay.
But it took me a few years to figure out that I hated it, and then it took me a couple of years to get out of it. And the way I got out of it was that I was working on these safe harbor leasing transactions, which were basically, for a very short period of time, you were able to simply transfer tax benefits, like investment tax credits and depreciation, interest deductions. So
Really?
companies that,
oh, wow.
it was a narrow window, because normally you have to have an equitable interest in the asset to be able to take the benefits. But this was in 1983, and Congress wanted to encourage, because they wanted to encourage, I don't know, give people a benny. It was a recession. It was something that they could do. So for a 3-month period, only a 3-month period, you could enter into these transactions. And I had a client that was a very, very profitable. I was working at a big firm, very profitable pharmaceutical company that was buying tax credits from lots of unprofitable companies, no matter what in different industries. And in that process, the companies were introduced by investment bankers. And there was one guy who was particularly active, a guy named Henry Miller, who was at Lehman Brothers. And we did a lot of transactions with Lehman and with Henry. And when December 31st rolled past and those deals were done, Henry called me and said, look, I think we want to give you a job here doing new product development. And so I ended up at Lehman, which was just, it was kind of, talk about how people fall into things. It was just, dumb luck that I got
this
there.
is in the early 80s?
This was in 83, 84.
So just the end of the bond bear market. We're about to experience the biggest bond bull market of the past century.
Just at the beginning of that. But the niche that I got into in working in new products was it had just been a 6 or 7 years of bond defaults and loan defaults by developing countries. So Mexico, Poland, Ecuador, Congo, you name it. 30 countries defaulted on their sovereign debt, so in a guy named Jeff Garton, who later went on to run the business school at Yale, came to the new product committee and said, "You guys should look at whether you might develop a market in these defaulted bank loans." And it was kind of a stretch because at that point, remember, this is pretty early days. It's just the beginning of the junk bond market, and there was no market in bank loans at all, much less defaulted bank loans.
Okay.
But so having been a lawyer 6 minutes earlier, didn't know any of those things. I thought, well, this is just I'll go out and I'll figure this one out. And and Lehman was amazing that way, just giving people agency. And so I went out and interviewed a lot of banks, and all the banks said, "Oh yeah, we'd love to trade these things. We'd love to, get more Mexico and a little bit less Panama and maybe some Chile and some Brazil." And they thought that having made the mistake of owning these things in the first place, they then thought they could do a job of managing the portfolio, which in reality they couldn't.
Okay.
But they thought they could.
Right.
So I reported back, and the powers that were said, "It sounds good. Let's start a trading desk." And they looked around the room and said, "Well, who's going to run this desk?" And no hands went up because everybody had a business. They didn't need a non-business. So I raised my hand and said, "Well, I'd like to do it." And they looked at me and said, "But you're a lawyer. You don't really know anything." And I said, I "That's true, but you don't have anyone else to do it, so let me do it." And they did.
Wow.
And so, yeah, it was just, in retrospect, it was one of those wild situations where there was no business, there was no market. Somebody who didn't know anything about markets or business was assigned to start a business. And that was me in 1984.
Now they must have just traded by appointment, right? Like the quote must have been 20 at 40 or something like that. And was there any trading, or was it like walk us through what those early days were like?
Kevin, you really nailed it. Early days where you'd call one bank and say, and by the way, there's really no cash to speak of in this business. It was all swap meet of loans, and most of the business we did was trading a pot of, let's say, a cocktail of Chile and Mexico and Brazil for Panama and El Salvador and some Mexican corporate that was in default as well. So it was putting together these cocktails of assets. Okay. And with essentially two phones, left and right ear, and being in the middle of a transaction, and that's what the business was for about 3-4 years, until money started coming into it, and you can actually put a cash price on the assets, but very, very thin. And just to give you a sense of how primitive the market was, or how loose the controls were at Lehman, perhaps, we did everything on that desk. We wrote the documentation. We sent out the wire instructions. We moved the money around. We did everything. We were our own back office. It was just totally wrong.
Jay, I completely listen. I was an institutional equity derivative trader in the 90s, so it wasn't like it was when you started. And I remember people would phone me up, and it would be just like someone would introduce themselves and say, "Hi, it's Bob from Oklahoma Teachers. I need to buy 1 million of these the ETFs. I was trading the ETFs, and I would say to him, well, it comes at 20.5, and he'd say bought from you. And then I'd be like, okay, well, let's figure out how to pay for this now. It was just a different world in terms of compliance and looseness, wasn't it?
Completely different. And one of the most impactful meetings I had was with the chief risk officer at Lehman at that point, a guy named Alan Kaplan. The first time we made real money on a trade, and I think real money was $250,000, and
Okay.
that was real money, and especially for our little desk, it was all of a sudden it popped up, and Alan said, "You're doing what?"
Compliance didn't even know.
No, nobody knew, and so I went up to Alan's office, and Alan later became a great friend, and I'm telling you the story, which was a very important lesson for me. And he said, "What did you do, and how do you do it?" I told him this whole story, and he nodded and nodded and nodded, and he said, "And how'd you make the $250,000?" And I told him, and it was a little tricky because to make the money, we had a piece of these assets kind of falling out of the middle and we had to find someone to pay for it.
Oh.
So there were a few people who were willing to put cash into transactions. And I said, he said, "Well, where are the controls? Who's your, the usual questions a risk officer would ask." And I said, being a smart ass kid, said, "This is a riskless trade. We had parties on both sides. They're both banks." And he said, "Sonny, Sonny, there's no such thing as riskless."
Well, I was thinking it's very Lehman-esque how you said that you got the you got paid in product. Okay, so you're there and this is developing, and eventually it turns into more. I guess you're not just trading bank loans. You're trading. Is it end up being the debt of any kind of developing nation? Walk us through or explain to us how it developed over the kind of preceding decade?
Well, the market, yeah. So initially it was all bank loans. There are very few in that period of sovereign lending, which started in the late 70s with the passage of the Foreign Sovereign Immunities Act in the U.S. and the State Immunities Act in the U.K. Which allowed countries to waive their sovereign immunity so they could be sued in U.S. courts or in U.K. courts, and that was a sea change in the legal framework, because until then the immunities were very confusing, but mostly sovereign immunity was absolute. So this was an opportunity to have a statutory framework that allowed countries to agree with lenders that it not be absolute.
Okay.
And that was the genesis of the comment by Walter Wriston, completely accurate and also totally useless, that countries don't go bankrupt. And the reason he said that was because they can't declare bankruptcy. They end up in court, which in many ways was even worse. But so for 3 or 4 years, when I was just starting this desk, the paper would trade by appointment, very little cash in the market, but when there was cash, we would post prices on. We had little tiny Reuters screens, and I don't know if you remember those screens, but they were about 4 inches square.
Yeah,
and they sat on their desk, and they had like a little CRT in them.
They were green, right?
Green, yeah,
yeah.
little green screens.
Yeah.
And we started posting prices. And one day, I got a call from my boss, and he said, "You're posting prices." I said, "Yeah, we're posting prices." And he said, "Citibank doesn't like that."
What?
Well, exactly. Citibank doesn't like that. And we actually are trying to get in their underwriting business, and they want you to take the screen down. So we took the screen down because at that point, the banks still had not written off their third world bank loans. So they were up to their gills in third world bank loans, and which had not been reserved for yet. That came over the next few years. And they're also up to their gills in real estate. Right. So
You putting
So
a price means that all of a sudden have to market to that price.
could be a problem. So in the same period, we got a visit from a guy, a researcher from the New York Fed, and we were talking about, and because he was very curious about this little screen and these prices. And he said, what do those prices mean? So I went through the whole swap meet idea and the fact there's a little cash in the trade. And sometimes there were outright buyers. Mexican debt might trade at 65 cents on the dollar. But for the most part, it was a very, very thin market. So he said, well, how much could you trade? How much Mexican debt could you trade at 65? And I said, I don't know, maybe, give me a few days, 5 million, 10 million face. And he said, so your prices are meaningless. I said, well, I don't know what to make of prices being meaningless. It means something. And he said, but if someone asked you to sell 100 million, you couldn't. I said, well, I couldn't sell it at 65. I could sell it at 25. And that was kind of and that's when I think he went back and reported that, and that's when they decided to get serious about banks posting reserves against these assets, because all they needed was the market to develop, and you'd have a deeper market at very low prices, and maybe some people would jump ship and they'd start dumping, and then you'd have a real problem of whether banks had proper reserves on their balance sheets.
Okay, and was that the that whole Mexican crisis? Like I always I wasn't trading back then, and I always get them confused. Was that the start of that whole problem? That Volcker was the FOMC chair at the time, and then they eventually encouraged all the banks. They kept rates even a little bit lower, trying to get them to write these things off. And
yes, yeah, okay. It was that period, and this was also the ultimate solution for that particular debt crisis. Was what they called the Brady Plan.
That's
which
right.
Is essentially a wacky structure that defeased the debt by packaging debt with treasuries, and it was smoke and mirrors. It was camouflage, but it gave the banks a way to book over time, book reserves and kind of grow into the losses that they had accumulated over the years. So,
and that Brady Plan, did that enable people to trade your product? And now all of a sudden it became something that wasn't just by appointment and was trading on a more regular basis?
Yes, and that's when a lot more, many more people got into the business. The banks, in fact, for a little while, it was just us and Bear Stearns in the business, and then a couple of other investment banks got involved. But the commercial banks really, the big commercial banks, Citibank and J.P. Morgan, Manny Hanny, Chemical, Bankers Trust. Those banks were still banks then, and separate banks then. And they got, they're kind of annoyed that these kids on Wall Street were making money trading loans that they had originated. And so they all got into the business, and all of a sudden it became a big business because there are just more people in it making markets.
And you're running this division at this time. Is it moved? Like, I assume it was just you and another person at the beginning. Is it expanded? What were the next steps?
We probably had at Lehman at one point about 10 people doing this, and so we had salespeople, traders, back office people. It was it was becoming a profitable desk, and we were doing a lot of business. We had a pretty good reputation for that. But then after in the late 80s. I jumped ship and I went to start a desk at Morgan Stanley.
Okay.
And so that was in I think 89.
And they were behind and they wanted to get caught up.
Yeah, it was. I was recruited by John Mack, who
right.
Maybe you know John.
Yeah, well, I don't know him, but during the great financial crisis, you certainly saw a lot of them.
Yeah, typical John, Morgan Stanley. They saw a business they weren't in. They went out and they acquired a team of people and were in the business. And so I started that business there. And as part of that, we actually raised the first investment fund to invest in defaulted bank debt. So we started the first private partnership to invest in that as well. We had a few big pension funds as our lead investors.
Okay.
But the real revelation for me was I was sitting at my desk one day and I was reading what they call in law an advance sheet, and it was about a guy who had sued Paraguay and had actually gone to court and had attached assets to the central bank at a bank in New York. And I thought to myself, you idiot. Do you know the story about trading sardines?
I do, but why don't you tell everyone the story?
So during the Great Inflation, it could be anywhere, but let's say it was in Germany, after World War I, and people had need wheelbarrows full of currency to buy anything. It evolved into a barter culture. So people would trade shoes for sardines, for hammers, for overcoats, whatever. It was a swap meet in physical goods rather than currency, because the currency was worthless. And one day, one guy traded a pair of shoes for a can of sardines. And a couple of days later, went to the guy that he had acquired the sardines from and said, I ate these sardines and they were rancid. And the guy with the shoes said, why did you open the can? And the other guy said, well, because I was hungry. That's why I gave you the shoes. I wanted to eat. I wanted sardines. I said, no. Those were not eating sardines. Those were trading sardines.
Even though I knew the punchline, it's such a good story.
And it applies in so many things, right? Even we can think of plenty of cases today in the markets where things that you think are edible are really trading sardines.
Right. And so you were worried that by suing the Paraguayan central or government that he had opened the can of sardines.
So what I had missed was, and this is, shame on me, because having being a lawyer, having been a lawyer, I never actually read the contracts. Well, the contracts were thick and boring, and
One second, Jay, you're just like every other trader. That's
exactly. Just like every other trader, right? I don't need to know what it says. I just know what the price is.
I'm just going to make a price on it. Okay.
And so I actually got the contracts, which weren't easy to get because they were in some vault somewhere. You had to ask for it and get the bank to get it for you. And anyway, I got the contracts and I started reading them. And then I called the guy that had been the lawyer for that case. And I educated myself, and I discovered that there were very few cases at that point involving this legislation, this Foreign Sovereign Immunities Act, but there were a few. There were maybe 5 or 6. I read them all, and I thought, wow, this means that if you don't want to go into one of these crummy restructuring deals, where you're cutting your principal by, you're giving away the interest and you're cutting the principal by 50 or 60%, even though the country is money good, because there's this herd mentality and the banks just want to solve these restructurings and get out of them. You can actually hold out, ask to be paid more, or go to court and sue to get paid later after the restructuring's closed. So I wrote this up and I went to see John. And John, if you're listening, I think you can confirm this story. I went to see John. I said, John, I think I have an interesting angle to our business. I told him the story, and he said, whoa. Let me get this straight. We're going to rock the boat in these restructurings, even though all these banks are our clients. I said, right. And then we're not going to take 50 cents on the dollar. We're going to hold out for 100%, even though they just took 50. Is it right? And if we're not successful in negotiating a better price, we're going to sue countries. I said, yeah, exactly.
That went over like a lead balloon.
And he said, exactly, never. So I decided that this was just too interesting. Sometimes you're just bitten by something and you decide. I was young, I was exuberant, I was arrogant, I was inexperienced, that I was gonna do this.
Right.
So I left Morgan Stanley, and I had a couple of false starts. I I put together a small fund of very sophisticated European investors. But as soon as we brought our first lawsuit, somehow my investors, the lawyers found out who my investors were, and they went to them, and they started rattling their cages, and they really became afraid because I was going to rock the boat, and they had a good thing going. So my investors said, look, we didn't know what this would entail. This is a lot of pressure. We're Europeans. There are some European countries that you're going after. So we ended that. So then I had to start over again. I went to I found an investor in a small fund who, and put together a great package of assets. But then that guy ran into trouble. He can remain nameless, and he had to sell out. So finally, I ended up, through one introduction to another, being handed off. I met Paul Singer at Elliott Management. This was in 1995, and 2 weeks later, I was at Elliott, and I was buying sovereign debt, and I was there for 22 years.
Wow. Okay, so tell us about. Why don't you tell us the first one that you sued successfully, and then after that, I want the one that the one that you're known for. Like when you pull up Jay Newman and Google them. Apart from your book, this is the one that you'll be known for. So we got two stories at the minimum we're coming at.
Well, the first was really, and this is public record, so it's not any trade secrets. But the first was the Republic of Peru, and the Republic of Peru was at that point run by God, now I'm blanking on his name, but it was incredibly Alberto Fujimori, and it was incredibly corrupt. He later had to leave the country, and he fled to Japan because he had dual citizenship. And his national security chief, Vladimir Montesinos, ended up taking a boat up the west coast of South America looking for a new home. So it was a very corrupt place. They owed not a lot of money. They owed about $8 billion. They had negotiated a deal with their banks to essentially forgive half of that. But we had been trading that for, I had been trading Peruvian debt for a long time, and was aware there was one very steady bid for it, and a very disciplined bidder. And I became convinced that the actual bidder was the Republic itself.
Okay.
And they were not telling their bankers that they were claiming that the debt outstanding was $8 billion. In reality, it was half of that, because they had purchased the other half at prices from 40, 50 cents on the dollar, and they were lying about the size of their debt stock. So this looked like it was a much stronger credit than anyone realized.
Okay.
And so that was the first one, and it went pretty well. It ended up in court.
So wait, so you bought the bonds and
bought the bank debt.
Or sorry, the bank debt, and in the meanwhile they're buying it at 50 cents on the dollar and reducing it and trying to pretend like things are worse, so that it keeps getting offered cheaper because they can buy it back cheaper there. So you buy it, and then what comes due and they don't pay, and then at that point you sue them.
Well, they were in the process of restructuring negotiation. So even while they were buying it, they were in negotiations with the bank advisory committee to restructure the debt, and they did that. And we didn't go into that deal. We held out, and eventually they just tried to literally strike us off the register. They just said, we don't recognize the debt you own.
Oh,
Wow.
yeah.
So we said, well, look, that's really not, I mean, that doesn't work for us.
Okay, so
So,
they tried this, and where do you sue them? Do you sue them in like New York court?
well, so this is the thing. So that statute that I mentioned enables you to sue in New York courts, and so that's what we did, and we ended up getting getting a judgment and seeking to enforce and essentially uh, attaching assets of the republic, and then we settled. So it was.
When you explain to people when you say attaching assets of the republic, what that is, and I think I understand, but I'm I'd like you to confirm it for me.
So once you get a judgment again, so if you're owed money, anybody, whether it's a person, company, country, you have to go to court to get a judgment. So you get a judge to say, yes, you're owed this money, and then you apply to the court for permission to seek to levy, to attach assets and actually enforce by taking bank accounts or real estate or boats or whatever you can find of the debtor. So that's the enforcement process. And to enforce, you attach the assets and then you seek to sell them.
So when you're attaching assets of a country, what do you like? What would be a typical asset that you might attach?
Well, countries, and by the way, the world for enforcing sovereign debt has gotten very, very complicated and much worse over the last 25 years. In fact, I think it's most of the sovereign debt outstanding today is pretty much unenforceable as a legal matter. It's enforceable as a social matter if you can get enough people on your side, but as a purely legal matter, it's become very difficult. But at that point, it was less difficult. And you would go after bank accounts. You would go after, in case of Peru, we sought to attach funds that were deposited at their bank before they were distributed to pay coupons. So there was a moment in time when the bank held property of the country before it became property of the indentured trustee to be used to satisfy the coupon. And then that was a loophole that, in any business, you're exploiting loopholes, sequentially, and that loophole was later closed. But that was the particular event that brought us to the table with Peru that enabled us to settle it with them.
So eventually they say, well, we'll pay you 90 cents or whatever, 95, whatever you guys agree on. And, right. and you get your money. Now, you mentioned that things have changed and this is no longer as applicable in terms of attaching assets and actually enforcing these contracts. I'm curious, what's changed over the last couple of decades?
What's changed is that the ecosystem of sovereign debt involves not just the issuers and their bankers, but also governments, Western governments, G7, G20, the IMF, the World Bank. So there's a whole ecosystem that, for no good reason, likes to see weaker countries, weaker credits be able to borrow in international capital markets. This, by the way, is truly a perverse phenomenon. And so what makes it particularly perverse is that anytime a sovereign defaults, this cohort, this ecosystem, all comes out of the woodwork to defend the defaulting sovereign. To the point where, over the course of my career, I think the U.S. government filed, no exaggeration, probably 25 amicus briefs, which are briefs filed by people who are quote unquote friends of the court, to let the court know what they think, even though they're not involved in litigation, but they have an interest and maybe some expertise. So let's just say the Department of Justice comes in and says to a judge in our case, as they did in many cases, we think as a matter of public policy, you should not be allowing the enforcement of these legitimate contracts.
Whoa.
And Yeah, and so the headwinds that that creditors were up against if they were involved in litigation often involved not just the legal process, which was time-consuming, cumbersome, expensive, very expensive, but also you had adversaries as powerful as the U.S. government, the British government, the IMF, because they're all defending. They thought they were defending the weak, if you will.
But
So
don't they understand that if you do that enough times, it eventually makes it so that the cost of acquiring the next set of debt is cheaper, is more expensive? Do
they
they
do
not think that through? Like that there's a consequence to their action, that people will be less likely to invest in the next round?
They do not understand that.
Okay.
Flat out, they don't understand it. I mean, we could relate that to sanctions on Russia. Maybe we'll talk about that later. But it's a similar concept. Government, people in government don't understand things like that at all.
Now you were, although it is harder, you still found a way to settle one of the largest sovereign debt cases ever. And why don't you tell the people about the story of, what was it, Argentina?
Yeah, Argentina is a wonderful country, but it has a very bad attitude, a cultural attitude toward the debt. I think Argentina has defaulted kind of major defaults on sovereign debt 6-7 times. They recently almost defaulted on their debt to the IMF, but the IMF rolled it over. And so when Argentina defaulted on their debt in the year 2000, it was no surprise, and that at that point there was no. Let me step back for 1 second, because it's the bonds and bank loans that were outstanding in the year 2000 had yet to be revised to dilute and change the contractual terms, which started happening in the year 2000 at the behest of the European Union and the US and the IMF. So the actual terms of bonds of debt issued after 2000 became worse as a contractual matter from the perspective of creditors. But the Argentine debt in the year 2000 was all old school. And Argentina essentially refused to negotiate. They refused to explain their capacity to pay. They refused to reform their fiscal habits. And yet they were able to achieve a restructuring of pretty much half their debt, on very bad terms. But the other half were held by people who really thought the whole process was wrong and didn't go into the deal. And that's what began starting in 2003, a 13-year legal fight, going through the courts for 13 years over getting paid. And that's a fight that that I was involved in from those very early days until finally the last cases were settled in 2016.
And when you think about that aspect of it, like chasing people in court and being the face of this restructuring, do you find you enjoyed that more than the old days of having a phone in one ear and the other ear and just being a simple trader?
Much more.
Oh, you do? Okay.
Yeah. It was it was challenging in the sense that I think all people who had not gone into that first restructuring were under a lot of pressure. There were then restructurings in the middle that cleaned up some other categories of debt. So the Argentines chipped away at their obligations for a long period of time, but they were in default for almost 20 years. But it was challenging because there were opportunities at every stage to try to negotiate resolutions, and at times, and many times during that period, it looked like it was going to be possible. And then it just kind of slipped away because politically, the Argentines, and this was really the administration of Nestor Kirchner and Cristina Kirchner, really politically it didn't suit them. They had already taken the pain of the default. They didn't have access to international capital or very limited access. And they were able to dine out on beating back the voracious gringos. So it kind of suited them politically, which is a big issue with dealing with any sovereign. The politics as we're seeing play out before our eyes today.
Now, we're going to get to your book in a second, but in your book, it's obvious that you're very well versed in terms of having traveled throughout the world and seen different things. Was any of this from your experiences as a hedge fund during this, or working for a hedge fund during this period? Like, did you end up having to go and enforce, sue people in courts throughout in strange places, or was most of this just in Manhattan?
Most of it was in the U.S., in the U.K., in France, sometimes in other countries, but primarily in the U.S. and the U.K. And it was.
Were you going and visiting these countries and negotiating like at strange places? Like, what sort of? I would love to hear. Most of us we're just traders sitting on a desk, and you've lived a very different life that was obviously much more international and
in very strange places. One of the cases that I was involved in dealt with the People's Republic of the Congo, and at one point a guy showed up at our doorstep offering us a suitcase full of documents, which of course, we couldn't accept, but all sorts of
they weren't documents; they were money. Is that what you're trying to?
It's look. You're always as a creditor trying to enforce claims. You're always looking for information about your debtor's assets, but a Congolese national showing up with a suitcase full of papers is not anything you want to be anywhere near. And I just use that as an example of pitfalls, and I'm gonna just describe, and that's where the idea for Undermoney, which is the title of my book, came from. And I just want to describe what Undermoney is because this was an example of Undermoney. It's money you don't see it, but it's there and it's influencing people and events. And in the course of my career, I think the career of many people in hedge funds, you're traveling the world, you're meeting people, you're trying to get information, you're trying to figure out how things fit together. Who are the good guys? Who are the bad guys? And so you're always looking for that information and that knowledge. And you're particularly trying to make sure you don't get hooked up with the wrong people. And in the course of my travels, there were plenty of charlatans that would come out of the woodwork with stories and deals. And, I think the big examples are the Alan Stanfords and the Bernie Madoffs and the Joe Lows, right? So you've got all those kinds of characters with various schemes and stratagems that are basically dishonest. But so the seeing all that was really very influential to me, when I started thinking about writing.
Right.
And because I thought, if I tried to tell the story as nonfiction, maybe the conversation we've just had is, it's interesting. Maybe it's fun for people, of our ilk who are involved in finance and markets because it's a kind of an esoteric, interesting thing. But I thought if I wrote a book about it, I might sell, 10.
Right.
So
why don't we take this opportunity to talk about how you eventually retire and your next stage of your life, and walk us through what you were thinking when you embarked on writing Undermoney.
So I had two things really got me thinking about the idea that maybe I had a story to tell, and one was I had a great friend at Morgan Stanley who's actually the model for the hero of Undermoney, Don Carter, and this friend of mine, also Don, was in the military. He went to Morgan Stanley to make some money, and then left, made some money, went back into the military, and for years, ever since. I've been hearing stories about his career and his special operations, and he ended up in Cyber Command at West Point. So a lot of stories about what was going on in the military, and in different venues, whether Afghanistan, Iraq, you name it. He was always there. And then one of my kids went to spend some time in Japan and became friendly with a restaurateur. And the restaurateur was going to open a place in New York, and he came. We took him out to dinner, and I asked him. I said, "Asano, is there any difference between the opening restaurant in Tokyo and in New York?" And he said, "No." And he rubbed his fingers together in the money sign, and he shoved them under the table, and he said, "Undermoney."
Oh, so he came up with your title.
The title, and I want to take credit for this. Undermoney is a new word in the English language.
Oh,
But I think that my hope is that everybody who hears the word undermoney is going to be thinking undermoney every time they open the paper, every time they see something they don't quite understand. If you see something in the world that you weren't like, that doesn't make any sense, and you say, how could that happen? The answer is always going to be undermoney.
that's a great way of putting it. I never thought about it that way.
So,
okay, so you have this burning desire. You decide, okay, I'm not gonna write this nonfiction book. I'm gonna write fiction. At this point, have you ever written fiction? Have you ever done anything like this?
I've written occasional op-eds, here and there, for the New York Observer, for the FT, for the Wall Street Journal, but we're talking about 800 words every couple of years, nothing serious. And I just sat down one day and decided I was going to try it, and crazy. And then after I had a manuscript, I was fortunate enough to be introduced to a fantastic agent, Sloan Harris at ICM, who, and I think about how rough, really rough my first draft was. I rewrote that book 4 times.
Okay.
Between that draft and the one that was finally published in January this year. And Sloan, he liked it. He had been the agent for Jason Matthews. You may have read Jason, who recently died, but he wrote the Red Sparrow series.
Oh, yeah. Okay. Yeah.
Yeah. So he had been Jason Matthews' agent, and I admired Jason's work. And so he took me on, and he said, I know just who to take this to. And it was actually Colin Harrison, who's the editor-in-chief of Scribner's, who had published the Red Sparrow books. And so they took on, these guys are, God bless them. They took on a total amateur, a rank amateur, and they beat the hell out of me, for 2 years, getting that book in shape. And that's really what it took. It took a couple of years of writing, rewriting, rethinking.
Well, so I had a confession that I made to Jay before we started, and the confession was, unfortunately, I am only halfway through, and the reason was Ukraine events came, and I ended up not having as much time. But I've told you that I enjoyed it. I've enjoyed it tremendously, so much, and I haven't actually let you know about this, my description of it. But if I was to think and try to describe what it is, I would say it's Tom Clancy meets Michael Lewis. So I think it's great. So why don't you tell people just briefly the kind of the bigger story, or just kind of, because I want to make sure that I don't give away anything that I'm not supposed to give away. So you tell people what it's about.
So what it's about is a group of patriots. It starts off with a squad of soldiers who are extremely disaffected with the way the country is going, with the divisiveness, with the waste. They're unhappy with how the military is being run. They're unhappy with politics, and they think they think there's an opportunity to do better if you had somebody who didn't care about currying favor with domestic elites. And so they decide the way they're going to do that is they're going to get one of their group elected to a higher office, and they're aiming high. They're aiming actually for the presidency, but they realize early on that in order to get anybody elected to any office, they need a lot of money. And this happens very early in the book, that they manage to steal a great deal of money. But the money itself becomes a character and an albatross, because it's not enough to have the money. You can't have, as they did, the money in a cave. You've got to put it in circulation. You got to be able to use it. And they stumble upon a hedge fund, in part because one of their group has become elected to be to the Senate, and a hedge fund guy is his patron, and the hedge fund guy runs into some trouble because the hedge fund is a corrupt hedge fund, and seeks some help. And in the course of seeking help, this group ends up deciding that they're going to take this hedge fund over, and it's going to be the vehicle to make money, and also a front for using money to achieve their foreign policy and their electoral goals. And so it's a very slippery slope, because they have the best of intentions, but once they realize that they need money, and that they decide that the ends justify the means, and they get into some bed with some really questionable people, including a guy that runs a Russian private military company. Actually, Vladimir Putin makes a cameo appearance in this book because he's the patron of this Russian mercenary. And it's a story about best intentions, but what happens when you put your goals ahead of your morality, and that's and things get. And one of the things that this I'm going to kind of, Kevin, I'd like to relate it to what's in a way what's happening today. The Russian, that they decide that to make money, they're going to do what they call make things happen. And they make all kinds of things happen that become trading opportunities. And these, typically, they're kinetic, so they're blowing things up, they're killing people, but they're always thinking about ways to do that in a way that will be tradable. And they're trading around that. And this, there's a, I have a description of what happened last year in between Saudi Arabia and Russia. I'm sure you recall this, when Saudi Arabia and Russia were debating as members of OPEC whether to increase production, cut production, and all the while they were having this debate, energy prices had become extremely volatile. I would say I have a moral certainty that the Saudis and the Russians were trading on what they were doing.
Yeah. You're preaching to the choir. Let's face it, gold went up for a month before Putin went into Ukraine. And if he can get away with shorting SPUs or doing whatever, why wouldn't he do that? These people, they have no morals.
No, there's no way they weren't doing it. I think they were trading European electricity, they were trading gas, they were trading oil, gold, as you said. They're trading everything. And so people talk about cutting Russia off from financial markets. Well, their bankroll got pretty fat over the last decade post Crimea, but over the last few months, from all the uncertainty they were creating in the markets.
So, wow, you're even more cynical than I am. So you're completely convinced that not only that, you think it's a sizable amount of money they're making.
I think yes. I think we're talking. Well, you can put a number on it probably better than I can, but I think that if you were dedicated to this and you knew exactly what Putin was going to do every day of the last 2 months,
yeah,
could you Could you make $1 trillion? Maybe.
Yeah. Well, it'd definitely be in the billions if you knew that, and you
Yeah.
could toss around, a lot of spoos. Okay, so one of the things about this book is I was just fascinated about the detail, and the reason I bring up Tom Clancy is because and Michael Lewis, it is both a finance book, but yet also a spy book. And
Mhm.
I was just thinking to myself, how does this fellow that is basically a Wall Street stiff like the rest of us know so much about the GRU and you name it? Was this just a lot of research, or is this just, you happen to know people that talk about this? Like, what was the genesis and where did this information come from?
So I leaned on my friends pretty hard, and I leaned on two military guys pretty hard. Uh, you know, Don Carmel and Ed Luzine, who influenced the creation of the book. So on the military stuff, I had the benefit of their thoughts,
Okay.
and they also they were kind enough to read it in draft. So I think I didn't get. I'm told I didn't get anything terribly wrong,
Okay.
which was very important to me. And on the finance side, just really talking to friends, because a lot of the transactions I describe in the book are not things that I was involved in directly, but things that that I knew about and was able to tap into other people and their knowledge. But a lot of it's just plain research. And one of the craziest things for me was that every time I thought I had an idea that I had invented something,
Yeah.
I would start researching it, and I realized that it had happened.
Do you have an example of that?
Well, I, the war in Syria, is case in point. I had not followed the efforts of the private military group, the Wagner Group, which was up against the Americans in Syria to take a bunch of oil fields, and we're going to be paid in the oil fields. And there was so I had this idea that the Russians and the Americans were at odds, and there was an enmity was created because Russians killed Americans, and so I had this whole theory about it. And then I started doing the research, and either I had internalized it in some way and had forgotten that I knew it, but it was all there. So the events that happened in Syria, in the aughts, were influential, and I use that as an important scene in the book.
So one of the things I'd like to do now is I'd like to quote your hedge fund villain. I guess he's a villain, and because I think it was interesting, and I'd love to get your point of view about whether you actually believe this or whether this is fiction. I just I thought it was really interesting. So here it is. So his name is Elias Vicker, and he runs a $500 billion hedge fund called Industrial Strategies. And I guess this is him talking in a Q&A. And he says, if you broke every decision to its component parts and then reassembled them, knowing everything about the parts, the decision-making machine, and the competitive environment, like Rockefeller did for oil and Ford did for cars, he could industrialize his investment decision-making process. How by applying back-breaking labor, he could make better investment decisions, how he could lower risk by being industrial and industrious. Is that actually what you think is the secret sauce to hedge funds?
Well, I think, well, so in his case, it's complete bullshit, right?
Right.
Because
Okay.
he's trading on on foreknowledge, right? But I do think that's what hedge funds do. I think hedge funds really apply. I thought you were going to read the section on where I describe the hedge fund brain, which is one of my favorite sections.
Okay. Well, I should have picked that one, but
No. It's all good. The So I do think that's what hedge funds do, and it's funny because the well-known uh, hedge fund investors who write about this stuff. I mean, George Soros writes about reflexivity. Ray Dalio has similar kind of theories on process. But I think that the successful hedge funds and anyone to be successful as an investor is applying a level of industry that is unusual in kind of the human population. It's a different kind of focus. So I very much believe that's what hedge funds do, and the best ones do it the best.
Now, one of the other things that Elias did in that same speech, I believe he compared it to a machine. And when I heard that, I thought, oh my goodness, there's somebody that I know that compares the economy to a machine. Are these characters a blends of everyone? Would that probably be the best way to describe it?
I think that's yeah. There's no what's the thing at the beginning of the book? No resemblance to anyone living or dead. But it's there are blends of lots of people that I met over the years and lots of ideas I thought of the years. The one character who's actually more a model of one person is Lorenzo Gonzaga, who's an Italian prince who is a senior executive at a small but powerful investment bank. And he's modeled on a particular guy who's a great friend of mine.
Okay.
And he knows
He knows it.
He knows who he is.
Yeah.
He's in the acknowledgments. I think he's pretty happy about it. Lorenzo is a scamp, but brilliant, wonderful, charming, like my buddy.
That's hilarious. Now, one of the other things about this Elias, because I found Elias very interesting. He says his mantra is not enough for the cats to win, the dogs must lose. And I thought that was like particularly vicious, but yet almost appropriate in terms of what I've seen. You talk about them being high functioning sociopaths or psychopaths. And I was wondering, do you think that is what unfortunately too many of the very best hedge fund managers end up being?
Yes, I do. There's a wonderful, and I refer to this in the book. There's a wonderful article by John Seabrook that was in the New Yorker about 10, 12 years ago now, called "Suffering Souls," and it's about psychopathy and its prevalence in the which is a diagnosis, a mental illness or mental condition, and it's 1% of the male population is psychopathic. So no empathy, no remorse, and Seabrook speculates that which industries attract and part of the article is they go into a maximum security prison and they scan the brains of these violent criminals, and they actually figure out there's a structure in the brain. If you can scan everybody's brain, you could figure out who the psychopaths are. So, and they actually brought a portable MRI machine to the parking lot at one of these prisons. So it's fascinating. And what occurred to me, I should have put this in the book, but I didn't. But what if we brought that portable MRI to the parking lot outside the Congress?
Or even worse, Wall Street. Well, actually, I'm not even worse. Probably the same. Who knows where there would be more psychopaths? It's funny that you mentioned that. My wife is very interested in psychology, and she tells the story of this professor that was studying that and how that when you see their brains, they actually have less activity, if I'm correct about it. So you can see it on the chart. Well, one time he had done, he had 2 sample sets that he had on his desk, and he said, "Oh, somebody's mixed up the psychopaths, and it might have been from jail. They might have been doing it from jail. Someone's mixed up the psychopaths with XYZ," and they say, "No, that's the group. And by the way, that's you." And it ended up being that he was a psychopath, and he didn't really realize it. And it was in this. I think it's a book. And it goes through his entire kind of realization of this and how things that he did when he was a kid, when he just didn't like excessive risk taking, didn't seem to care about others. And even this, I think he's a 60-year-old man while he's doing, he says, I try to feel, he says, I've taught myself to know what to say, but I don't really feel those things.
So amazing.
Yeah, it's kind of interesting. Okay, so when we were chatting earlier, I asked you I was trying to think of fun questions to ask based upon a fiction book because, we don't get a lot of fiction books here on the Huddle. And I thought what would be interesting is to find out who you would like, if this was turned into a movie, who you would like to play the part. And I said I left it open And I said you could choose anyone during any period. Like if you wanted to choose a young Robert Redford, you could do it. Now you had one for sure in mind. Do you have more than one? Because I've made my choices, and I'd love to shoot them by you. But I'm going to let you go first.
No, I need to know what you think because we're actually working on doing
casting it?
media rights. Yeah. Well, I don't know. I mean, no one's going to want to hear from me on casting, but I like Alicia Vikander for the female lead, Greta.
Okay.
And so I think she'd be, or Rebecca Ferguson is maybe my first choice.
Okay.
So those are my two thoughts on the guys. I'm not sure. Who do you think?
Okay, so I don't have the Tommy Taylor character. I didn't come up with someone from there. But Ben Corn, the junior senator, that's got Bradley Cooper written all over it for me.
It does.
Yeah, that's it. And then Greta Webb, you mentioned those actors. I would choose a young Jennifer Connelly, but she's not young anymore. And I was just kind of, that's how she seems in my head. So I'm not really sure. Don Carter, which is the hero in charge of security. He might be too old now, but I think he's an Ed Burns.
Ed Burns would be, or whoever Ed Burns is today.
Modern day Ed Burns. Fyodor Volk, who's the head of the Parsifal Group, which is kind of this creepy Russian guy, if I remember right. John Malkovich.
Yeah. Oh, yes.
Yeah.
Yes.
He would be good at that. And then finally, Elias Victor. I thought a lot about this. This is the hedge fund manager, and he's a psychopath and stuff. Robert Downey Jr.
Oh my God! Yes,
that's my picks. I don't know.
Okay, I'll be back to you on all that.
Oh, that's hilarious. Okay, so we're getting a little late. So why don't we finish up here with our final 3 questions or 4 questions? We're going to go with. Let's start with, what is your favorite investment book?
I'm gonna give you 3 books that are, I think, important and have been important to me, and they're not investment books per se. And the 3 are Thinking Fast and Slow by Daniel Kahneman, which is about how people think or don't think, and how they process information. And it's a kind of book, for me, it was very hard going, but I've read it twice. It's probably something you want to read every year. The other is Normal Accidents. It's kind of written by a sociologist, Charles Perrow. It talks about complex systems and how they fail. And it's relevant to, he uses a lot of examples in industry like nuclear power plants, but it applies to any complex system or network. And those are...
you got one more. You were going to name one more. The Logic of Collective Addition or Action.
So this is pretty esoteric, but it's certainly been relevant for me in my life. It's called The Logic of Collective Action by Manker Olson. And it one of the biggest problems that I faced as an investor, it was getting people organized to do the right thing together. And because, especially in the hedge fund world, lots of really smart people, a lot of testosterone, and even though there's an impeccable mathematical logic to working together closely, even pooling your assets, it just mostly doesn't happen because people can't see the way clear to give up enough control. So those 3 I think are really important because so much of what we do deals with psychology. And if we think about the psychology of the people around us and the ecosystem in which we're operating, I think it's very important and will help make us better investors and decision makers.
That's fascinating. It actually reminds me, Jay, of I was talking to a buddy today, and we were arguing about whether Putin is being rational right now. And I said, to me, it doesn't seem rational. And he would say, he was arguing that he's just rational in his own way, and you have to understand his way. And then I said, well, if you know that, you could make a fortune because you could figure it out. And he said, yeah. And then he says, I also think you're rational, where he's talking to me, but I can't always guess your trades. And I said, oh, that's true. Okay, so the next question is, are great traders born or made?
I think they're born. Or let me step back. I think it's there are some. It's a lot of nature, but it's some nurture. I think being able to take risk and think outside of the box, I think is something. I think it's a combination, but I don't think they're made. I think
You have to have that certain willingness to do it, and
yes.
Otherwise you just won't do it. I tend to agree that it is a combination, and I have no doubt that you can figure out how to trade even if you don't like it, but you're not going to like it unless you have you were born with that. And the example I always give is, I remember when I was on the desk and this kid in research, that was a research associate, got sent down because he always wanted to be a trader, or so he thought. He sat there for a week and a half and was just sick with worry the whole time. And, after the 2 weeks, he just headed back up to research.
Yep.
And I feel like that's it.
You just described it. It's not for everybody.
Right. Okay. So Don Cox, which is my new favorite question, is a Canadian strategist that always says that you shouldn't invest based upon what is on page 1 today. You should look for stories or themes that are on page 16 today on their way to page 1 in the future. Do you have an example of that for us?
I do have one. I think what's on it, and it's on page 1 and it's on page 16. What's on page 1 is energy and security, and had oil not been as lucrative and gas not been as lucrative for Russia to be able to build up these vast reserves and control so much of Europe, because 30% of European gas, 30% of European energy comes from Nord Stream 1. We would be in a very different situation. Russia will be in a different situation today. So I think that what's on page 16 is the story that is the next generation nuclear. And I think that we'll have no choice but to re-embrace nuclear. There are much safer technologies. In fact, there are new materials like thorium that could be used. There's been talk about hydrogen forever, but uranium and thorium are two materials that actually could be used to generate power. And so I think that's what I'm looking at that as an investor and also as a novelist, because I think that's going to be, it's got to be part of our. If there's going to be an energy transition from hydrocarbons to something else or some other things, it's got to be through nuclear.
Right. And do you have any specific ways to play it, or is just the uranium, the uranium miners or the spot ETF, or do you have anything kind of out that might not be on the radar screen of everyone that's saying you should look at this as the thorium reactors or anything of that nature?
What I'm looking for that I don't have yet are the making decisions about which companies have the technologies that are going to really be scalable, and so what are the penny stocks that are really going to succeed, and that's what I'm looking for. I don't have that yet.
Right. Okay. Well, I'll have to get you back on when you do.
Okay.
Okay. And the final question is, if you were to be giving advice to a young person that's starting out in our investment business, what advice would you give them?
And this is a really, it's a hard thing to do. To be thoughtful and mindful about where you're working and the culture of the place you're working. It's as young people, and I certainly I didn't have any master plan, and as a young person, you don't really understand the dynamics necessarily of the environment you're working in. But the extent you can understand who you'll be working for and with, and the nature of the organization, I think it's extremely important, especially people who are going to be in trading environments and hedge funds, because cultures can be toxic and they can be supportive. And And I think over time, if you're going to develop as a in any way in business and life, you've got to be in an environment that works for you. So that's my best advice, as imprecise as that is.
No, it's great advice. Okay, so for people that are interested in finding your book, why don't you once again tell them the name, tell them where they can find it in the whole 9 yards.
The name is Undermoney, one word, and it's not yet in the dictionary. But if you Google it, you can find the book, and the book is available at wherever fine literature is sold. Amazon, Barnes and Noble, major book, any bookstore worth its salt is going to have Undermoney on the shelf.
That's right. And for those who don't, I find as I've gotten older, a lot of people in our industry don't read enough fiction or any fiction. And I would say that this is, if you're going to branch out from your nonfiction reading, this is it, because there's a lot of gems of wisdom, and then yet it's an entertaining, terrific read. I look forward to finishing the second half. And Jay, it's just been an absolute pleasure being on the show with you today, and thank you very much for coming.
My pleasure. Thank you, Kevin.
All right, Patrick, it's time for talking charts, and there's definitely a lot to talk about.
Wow. Right? Like, what a week. So let's jump straight to it. Let's first just go through what were the top 3 things we were watching last week. And we asked, does the equity weakness continue into next week? And, Putin didn't disappoint on that one, did he? But what a intra-week swing. I mean, we started the week wiping out 300 plus S&P points in a very short order. And then the moment the buy rumor, sell news, it almost to the T reversed the markets, and just a screaming almost 300-point rally back the other way. Just one big ping pong bounce off of the lows. So the selling did continue, but huge intraday reversal. One of the things I want to talk about a little bit later as to whether this can actually sustain and hold on that bounce. But certainly the weakness did continue last week. The number 2 we were watching is the bond carnage over. And things, I don't know if anything's really changed in the bond market, but things actually seem to have quieted down. Is that what you're feeling as well?
I don't know if it's. Yeah, I guess it has. The action is definitely borne other instruments as opposed to the bond market. It's gotten
right.
quieter.
Like it's not that there's been a bullish reversal in bonds and yields have been coming off, but this is simply not where the action has been this week. There are so many assets that moved in big ways, but the bonds were not it.
I would agree with that analysis.
Yeah, and so, is it over? I don't know. But what's interesting is our number 1 was we didn't want to Gucci it, and we said, is gold going to Prairie Dog? And boy, did gold have a crazy week. Now, the interesting thing, we even bet on this, but the Prairie Dog actually happened later in the week. We were really kind of asking about that one breakout candle that happened on the Friday, but gold almost hit 2,000 on that huge rip higher on the news, and then gave it all back. What a crazy pop and drop. What's your take on that?
So in terms of gold, the way I was thinking about it is that obviously on the horrific news about the Russian army going into Ukraine, there was lots of scare, worry, and obviously there's loss of human life. It's tragic. It's terrible. War is bad, just period. But people were reaching for the gold at that morning when things were the most unsure, Patrick.
Yeah.
And one of the things that struck me is, at that point, Putin and the Russian central bank, it seemed obvious that they were going to be sanctions coming. It was going to get worse. And the reality is that if you think about it, they probably bought gold in front of that. This past month, they've probably been buying the whole time. And given that it's going to be increasingly difficult for them to transact, they're probably going to be selling. And so to me, it was just a pure, buy the rumor, sell the news event on gold. And I think it probably, Patrick, you're probably going to like this. I think it struggles for a bit. I'm not a big, huge gold's going back to 2,500 tomorrow kind of guy, and I think that it probably struggles. I think all commodities. I'll take it. I'll go even further. I think all commodities might struggle in the weeks coming here. And if you just pull up like the Bloomberg Commodity Index, you'll see.
We'll look at the commodities here in a second because when we talk broader things. But I think that while in principle I agree with your sort of bigger commodity call, I'm not so sure that there's going to be a huge throwback in gold. Gold certainly.
I'm not trying to say I think it's headed back to 1,800 or 1,750. I'm just saying.
Well, I mean, you almost made it sound like that.
I didn't mean to do that. I just saying that I don't. I just think it chops and it doesn't. It chews up both the bears and bulls. Is what's my kind of working hypothesis of it.
Well, typically after an advance of that magnitude, right, you usually have a market pause and backfill, and so it's not out of character for a 1 week or 2 week consolidation. We could be back here 2 weeks after our 1 week off from the episode. We might end up consolidating, and we might not be breaking out in any way 2 weeks later. So yeah, it could probably be quiet here for the rest of February and the first part of March, but I still actually have a bullish tilt on gold here. Anyway, so let's talk about the top 3 things we're watching next week. And the number 3 is we've got those job numbers coming out, and obviously we won't be there next week to kind of on the episode to talk about what will happen. But you think that the jobs numbers keep strengthening here, or what's your take?
I don't know, Patrick. It really does. It's becoming increasingly difficult to forecast these numbers because there's so much variability in them. Having said that, I was expecting economic numbers to start surprising on the downside versus expectations, and I've been wrong. You just had to look at the inflation numbers that came out today. They were higher than expected. This economy just continues to show signs of being stronger than everyone expects. So I don't know. I just don't know, Patrick, but I definitely feel like a lot of people are looking for the economy to roll over, and it'll be interesting if it doesn't.
All right, so number 2, we're I wrote central banks, but obviously the Fed, Powell is testifying next week, and then we have the Bank of Canada and a few other little central bank things going on. Certainly will be interesting to see whether there's a tone now that this economic sanctions and all these different variables coming in. Does the tone of the Fed or Powell change when he's testifying? What's your take on?
I don't. The problem with the Federal Reserve right now is that it's torn. There's probably some that want to go 50. There's probably some that want to go 25. There's also the fact that we have the Ukrainian situation is increasing the variability in terms of their worry about that it could spread. And then to top it all off, Patrick, he's still not approved. He still hasn't been, renominated through the Senate. So my feeling is he's going to play it as close to the vest as he can, and just keep his options open. That's certainly what I would do.
Yeah. Number 1, we certainly want to see how the escalation in Ukraine continues. I mean, obviously the first part of this has played out, but now comes the grind as to whether or not this is going to be a quick little thing, or whether or not this is going to be a prolonged confrontation, and how, more importantly, when does the market stop reacting to every headline? What's your take on this?
So I would be shocked if it's any sort of resolution is achieved over the next little while. And to me, a win would be it not getting significantly worse. And one of the things that I worry about is that war is terrible. And as I said, nobody wants war. These are human lives. These are people, the brothers and sisters and sons and daughters that are dying, and families getting ripped apart. So it's terrible. And what I worry about when I think about how this could go wrong or get worse is if it ends up being that Putin feels more and more trapped by it not going well, that he resorts to bigger and more deadlier forms of armaments. And that's what really scares me, Patrick. So I listen. I watch the videos. I watch everything. I'm heartbroken. I think it's just terrible, and I don't know what to say except that I'm worried about it. And when we were discussing this top 3 things to watch, I just said it has to be number 1. It has to be the thing that everyone's watching, because the potential of it getting worse and spreading or really taking another leg in terms of getting more serious is there, and you have to be aware of it.
Okay, so I want to be sensitive to the topic you're basically saying, which is that the human life and all these different things. But let's just a moment step back and see what the market reactions have been, because overall, in spite of the military confrontation beginning, we have seen the stock market respond with an extraordinary bullish reaction on first. And obviously it was a very oversold condition, a lot of markets making big moves. And the bigger question here, is this sustainable, right? And so like the S&P 500 is almost back to 4,400, where almost that's pretty much where we started a recording last week, right? And just a huge drop and then pop. But the question is this the conditions with this type of a confrontation from which the market will just keep ripping bullishly higher? And or should this rally be faded? One of the interesting things I saw on Twitter, and I don't know if you saw those tweets, but like some of the biggest reactions in bullish reactions off of lows occur in the middle of bear markets. And so you have this violent rally where essentially the market here has rallied 7% in less than 48 hours. On the upside, 300 S&P points. So the question is that just this reaction, or is it actually a sustainable turn? And how bullish can a market get with this type of a geopolitical drop?
So the way I'd answer that is, I think you have to ask yourself 2 questions. 1, does Ukraine get worse? And if it gets worse, significantly worse, then it doesn't matter. I think it's going to be difficult for any risk asset to rally. And then number 2 is the economy rolling over or not? And I think that's something people are missing. And if you believe that the economy is rolling over, then chances are any sort of rally is just a chance to sell. Because that's just the way this works. If the Fed's about to hike and cause significant pain in the economy, and we're about to experience a downdraft, then you should probably be selling your stocks, and especially in any sorts of rallies. But if the economy is not about to roll over, and the Ukraine somehow finds a way of stabilizing, hopefully, and it just ends up being off the front page, then we could go higher, Patrick.
Yeah,
and that's the way I look at it. Those are the 2 questions you should be asking yourself.
So to me, 4,400 right here is right around where the fib retracement zone is, and not far from some of the key moving averages, like the 200-day moving average. To me, if this bounce was just an incredible, it could have just been like almost like a dealer gamma driven whip, where just the volatility was so high and the sentiment was so negative that we just got that slingshot reaction the other way. In my mind, if we start next week and we can't get any momentum north of 4,400, every day that we stay below 4,400 increases the likelihood the whole thing is going to roll over and sell again. To me, that becomes like a pivot. Above, you give the bulls the benefit of the doubt. Below, I would still stay very, very cautious on this market.
Sounds good.
All right, but I just wanted to touch on that. Is that a prairie dog on the U.S. dollar?
Sure looks like it, doesn't it? Not a pure one, because a pure one is like the range that it's breaking out of is more extended and it looks
Well,
like
you know
like
what?
the prairies.
Yeah, but the one thing. Okay, so let's just like if you did on something at the a euro or something where you had like the volume by price profiling more relevant, almost all the consolidation happened in this zone, right? So there were two little pops above these areas, and each time they gave it back.
That's true. The prairie dog's looking out, and each time it gets. Oh no, I'm back in my hole.
Back
Yeah.
in the hole, right?
A very noble animal, by the way.
Exactly. And so, in my mind, the real test will be whether or not the bulls buy this dip that just happened today. As we approach, like if we get all the way down to 96 or 95, 50 on the Dixie, that's getting a little bit worrisome. That the dollar is not going to hold, and that so about the 113 level on the euro. The way I look at it is the dollar is still bullish if the euro stays below 113, and it really could be a complete big fake out if we see like the euro punching 114, 115. It might even be an argument to be made to be bullish it, right? But let's talk oil. Now that was one big pop. But what was interesting to me about that punch toward 100 on the upside, or as we printed up to 100 on an intraday basis and then gave it all back? Did you notice that energy stocks didn't react at all to the pop?
Except the point that it was rallying, oil was rallying to its highest, was when there was the most uncertainty regarding the invasion in the Ukraine.
Yeah, but you know what though? It's just it's this idea that most people express their long energy views through those energy companies, and you had a scenario where oil pops and the energy companies were being sold into that rally, which is, I mean, look, it's not 100% correlation between energy companies and oil. I just thought it was really interesting that oil was ripping and energy stocks were being sold.
Yeah, and if you look at this whole week, it's basically gone nowhere.
Yeah.
There was a lot of action the one day, but otherwise it's been actually pretty muted in oil.
The interesting question, like, could there be a deja vu of the Iraqi war oil reaction? Because, like, it's just going back to that period in 2003, oil was up like over 50% in anticipation that there was going to be a confrontation. And then once the bombs started flying, oil goes and like literally collapses $10 a barrel, like 25% in a span of just weeks. And now rarely does that kind of an analog play out perfectly 2 times in a row, but could this really be a buy rumor, sell news? And now that this confrontation is underway, that finally some profit taking happens here?
Well, the oil bulls will tell you no. That this inventory has never.
But listen,
the inventories have never been tighter, and that there's all the reasons in the world to buy it, and it's going to $200 or $500, whatever. Pick your crazy number.
First of all, I completely remain oil bullish in the bigger picture, right? Like what we're talking about is the fact that there was a war premium being priced into these into this chart. And now that this confrontation, suddenly that's spurring people that are saying, well, I'm not getting what I want out of oil, even though all of this confrontation's going, and it could spur margin calls, right?
Yeah.
And
Patrick, remember, markets top on the absolute best news. That's just the way the markets go. It's going to be the most bullish at the very top. Yeah. And you won't know till later, but I don't want to say too much, but I'm with you, Patrick. Like I think that there's a good chance that we're close, and that the next $10
they'll just lead to the
than
next buying opportunity, right? Like it's just a matter of just making sure you trade the cycles, right, along the way. I wanted to just move on to uranium. It started.
Oh my gosh, I got so many DMs today. Everyone was so excited about it. I guess what happened was there's a big buyer. RBC came and bought 6-7 million shares of the U.UN, which is SPUT. the way I look at it is some big hedge fund came, took some offerings, brought it up to the point where the at the market, yes, that was called at the market ATM deal, at the market issuance could occur. They bought it. Sprott sold issued more shares, and then went out and bought all the spot that was there. And the way I look at it is they cleaned up all the spot. There was no more spot left, Patrick, and so at that point they can just put it wherever they want. And now the real question is, when does more spot come back? I don't know. But it does look good, I must say. Our friend was one of those guys DMing me, and he was pretty excited about it.
Yeah.
The cuppy was pretty excited.
But interesting, like Cameco, just looking at this chart, had obviously that on its earnings a really nice positive gap. Did a bit of a gap fill wedging formation. Nice bullish engulfing candle coming out of the wedge. Looks like it's turning up. Maybe these uranium plays are. You know what I like about them versus things like energy stocks? There's some asymmetry in this trade. They've already been correcting for months, and you're buying at a tactical time versus a lot of the other plays have already had such big runs that there's always room of getting caught in a bigger market correction, right?
You have such a way of making chart formation sound so sexy, Patrick.
Sexy, is that what it is?
And
right?
it's sexy. It's like talk to me in your chart language there, and I could just see it.
There you go. So so we talked about gold already. Silver had that same pop and drop, but you know what was interesting was initially, while all these commodities were turning, wheat held up. And I went on to that show that I cheat on you with, and I was like talking about how impressive it was. That,
so you're to blame for today's weakness.
Exactly. It's like I goochered it for everybody.
For sure.
I come on there. It's like, look, you know what? All the other commodities turned, but wheat didn't, right? Like,
next day, wheat's like, I'm down $75. Limit offered. How much do you want?
Just egg all over my face.
Oh,
it's just
God,
like,
that's hilarious, buddy.
It's just like all of these, whether it's wheat or that reversal in corn, or even in the beans, soybean as well. Like they just all got hammered.
I sold, Patrick, almost all my commodities on that.
But you held the OJ, right?
I still haven't done the OJ. But I sold them all. I was like, this just seemed like it would just.
Dude.
Well, that's good.
I bought one.
Well, that's good. You got to keep it. I just figured, though, it just felt to me that people were so excited about it. It just felt like you had to sell the news, and that's what I did. It hurt because for a little bit, like I was offside, but then I look at today and I'm like, thank God.
There you go. All right, that's all I've got, bud. So let's move on.
Okay.
All right. So. Let's do skin in the game.
Oh yeah, skin in the game. I lose another one.
You did. It was the prairie dog bet on gold, but it just prairie dogged off of a much higher level.
I know. Had it started, it was just the initial move, and then it was too high for me to make it.
Yeah.
Yeah.
What was it? Did I clip you for a case of beer?
Yes, I think you did.
Bam.
Yeah. Okay, let me tell everyone about it. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode. Oh, and what are we going to do here? Do you want to do a 2-week one?
Yeah, that's what I was about to ask you. Should we do a 2-week bet?
Let's do a 2-week one then. Okay, we're gonna alter the rules today, and the currency for the wagers is as follows: a Duke and Duke, a pint of beer. I think instead of calling it a Duke and Duke, I just decided Bob and Doug McKenzie. Well, let's call it a Mackenzie and Mackenzie.
Nice.
Okay. A pint of beer, a burger bet, a pitcher, a case of beer, a bottle of wine with a $100 limit, and then the granddaddy, the steak dinner. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. Okay. What do you got for me?
You know what? If we're going to go 2 weeks out, I can't think of anything more than I want to do with you than just a spoos. Like 4,400 right there, the pivot. But 2 weeks out,
Yeah.
Is the stock market going to be higher or lower than this 4,400 level?
Oh, that's a sneaky one. Wait, 4,400? You're like,
Yeah, I'm going a
where
little
did it
higher. I'm going higher. We're at 4,380. So
that doesn't matter.
so
Okay, that's the rounding error. Okay.
I just thought a nice clean round number.
Okay,
Of
and are we doing
4,400.
the? We're going to do the cash. Or we're going to do the 2 weeks. The March.
2 weeks.
The March
No, 2
futures.
weeks. We're
We're going to do
yeah.
March though, because we got to be careful because there might be a roll and June might be front by then.
Okay.
Okay, March future 2 weeks from now,
Okay.
44. You know, I got to go higher just because on the whole, the stock market goes up more than it goes down. Although part of me wants to take down, but I'm going to go up.
All right.
I suspect you want to go down, right? So we might have a serious bet going.
I'm just gonna take the other side of the bet. Let's do it.
I want to do our brand new Mackenzie.
Okay.
Just to do one.
But you know what? Actually, I did give you one, so you do have a currency to settle it in.
Yeah, I don't want to lose that though.
No, so like you're gonna have to go and find another one.
Yeah, but
You're
it's
gonna have
okay.
to go-
I can give you back mine that I still have.
No, I know, but that's not. Remember, no netting of positions.
Oh, that's
I
correct.
think.
I'll have to go find one down.
All right.
Okay, so
Done. I still have a few, so we're good for this bet.
okay, sounds good. Well, you know what you can do? You can sell me one at a good price.
All right, sounds good. All right.
Comes at $100.
There you go. All right, so it's time for no stupid questions. So Lena, save us from this mess.
Sure. Before we
Sure.
move on, why don't you just do loonies instead?
It's not as fun.
No.
Not as
No.
fun.
No.
It confuses our American audience when we use coins. It's like me when I got off when I was 16 years old and I went to England and I got off and I brought all these pound notes and then I went to buy something, a stick of gum at the airport, and they handed me a bunch of change and I thought I got ripped off, which I probably did. Okay. And then it was even worse than that because there was it's not just coins, but then they have pounds and pennies and shillings, and so they're not even using the same denominator. It's just a shit show. It's like I understand how Americans feel when they come here. Okay, go ahead.
Okay, first, Lena, Kevin, and Patrick, thank you for a great show and teaching me so much about the markets. Sorry for boring questions, but it may help me avoid a great story one day about when my account blew up. Smiley face. You talked about commodity margins rules changing a couple of weeks ago. I have a question about managing fluctuating margin, which I have not seen discussed elsewhere. This is important as oil and other commodity prices become more political and more volatile. I have a lot of oil calls and call spreads, which I will likely hold for some time. The initial margin on my account is about 10 times the maintenance margin, which potentially leaves a lot of idle cash as the value of my holdings has grown. My questions are: 1, is there a best approach or rules of thumb to manage the initial margin as part of an overall portfolio? 2, when the margin rules have changed in the past, how fast has it happened? And 3, modeling margin seems a bit of a black art. Are you aware of any charts of how margin shifted in previous commodity spikes, especially when oil was circa $150?
All right. Well, first of all, let me just start off here, Kev. The first thing is that when you are buying call options, so if you're long oil calls, you're just paying the call options outright, and there is no margin to carry those. And even with call spreads, if those are debit spreads, then you're only outlaying the debit. If you're obviously doing a credit spread, then it's the spread between. But the margin won't change on option strategies on oil. So really, where the sensitivity, if I'm correct, you can obviously come in here and Kevin save me if I'm doing. But as far as I'm aware, the only real issue is for people that are actually long the oil futures contracts, which is where if the oil margin changes, then suddenly you might get in a margin pinch, and that's where you're going to be challenged, right?
That's correct. Or if you had sold the option short, you're also the margin will be based upon the futures contract.
Oh, yes, if you're
Right.
short.
But if you're
So,
long premium, all that you're going to do is...
I'm assuming when he's saying he's long oil calls and call spreads, I'm assuming that
That's right.
He's probably loaded up on the long side.
Yeah. So if you're long, that's not going to change. And then let's go through, though. Well, let me just say, let's answer the third one. Are there any charts that show the previous price spikes and shows the margins? No, not that I'm aware of, but I'm wondering if you go and reach out to the exchange, if they have that data somewhere on the exchange. And I'll answer the next question is how fast it's happened. It can happen really quick, overnight. And actually, I think there's times that if I remember correct, it happens midday even. Volatility goes up. There's an event.
The one that I recall that happened was in the silver market when silver was making its big rip to 50. And when it was up along, ripping to the upside, they just hammered the margin requirements, and that just like completely peaked out silver at the top.
Yeah, but it can happen, and I don't know if I'm wrong, but there's a chance that it could even happen multiple times a day if things were really crazy. There's nothing stopping.
Because they're ball adjusting these margins, right? Like, so in the end, they just need to make sure there's enough collateral put into these accounts to deal with the swings that can occur in the underlying, right?
That's right. And the way you think about it, let's just take S&P. It's trading at 4,500, let's say, and let's just imagine the margin is 500 S&P points. You know that if on a typical day, if the S&P moves 200 points, that everyone's going to have enough margin in their accounts to account for that. All of a sudden, if S&P starts to move 400 points, you might say as the kind of the group that is in charge of setting margins, hey, wait, that's not enough. And then if we get 600, 700, you'll be like, whoa, that's definitely not enough. Let's go and let's crank it. And it's really a function of the underlying conditions of the market. And there are no rules. The rules are that the clearinghouse is going to set a margin to make sure that they protect themselves so that there is no defaults.
Right.
Yeah. Anyways, it's a great question.
All right. So next one, Lena.
Second question here. Love the show. Guest variety is fantastic. I'm sure you'd heard it before, but would love a heads up in advance of the weekly beer in order to attempt to get in on action, or even better, get some type of subscription distributor lined up to mail to the Huddlers. Might even be able to mint a few loonies in the process to throw a blowout piss.
I think can I just interrupt there? I think that's a great idea. The thing is, we have to get Patrick to actually be in our country for a little while, because it seems like every time I turn, he's going somewhere without me, and I can't even get the beers he's drinking.
We usually don't even know until last minute.
Yeah, because Patrick's running out to the bar and finding one. That's what happens when you got an international man of mystery like Patrick on the show.
There you go.
Yeah.
Anyway. But one day we'll start our own Huddle brewery, and we'll have a delivery service around the world of the Huddle beers.
That's right. Well, and then, or at the very least, one day Patrick will nail a trade so great with his crayons that he'll have a private jet and he can just fly it back. Like, he'll be like, I'm in Lisbon, but I got this beer. I'm going to fly it out to you, Kev. Like Ubering, like a meal to me.
The carbon footprint on that sounds like,
I'm Canadian. We have lots of oil. We want to burn it. I know. I'm going to get myself in trouble with that kind of stuff. Okay, keep going. Sorry.
Let's go.
All right. Anyway, had a couple of questions. One, what are the effects of drastic changes in inflation on equity charts? It has to have some kind of effect since equities are priced nominally. I ask because I'm seeing a lot of 10 to 20-year charts with channels thrown around, but no discussion on what a real change in inflation could mean to those channels. Two, recently picked up a few flyers on some RSX leaps. I'm relatively new to investing in warmongering ETFs, so maybe you boomers could fill me in on some risks you've experienced during the first two big ones. Also, wife finally asked about crypto for the first time. She's a dentist. Huddle on.
There we go. That is some awesome intel there. I love the last part. I love that intel. It's time to get some more pink tickets out on the crypto, folks. Okay. But by the way, when he says asking us boomers about you've experienced on the first two big ones, does he mean world wars? I think he did. I think that's what he was implying, that we're been around, like we're like Matt Damon this thing, and we're that old. Okay, you want to? Do you want me to take this, or you want to go ahead, Patrick?
Well, I'm just gonna. I'm sure you're gonna have a lot to say about it, but I mean, there are different ways inflation influences equity markets, and I think that that's one of the biggest faux pas of technicians. For while I do dabble in the dark arts quite a bit, the one thing is that when you go too far out and look at too long-term chart of a time frame for charts, they rarely adjust over those long terms accurately for the different changes of monetary value and the conditions of nominal versus real value of those underlyings. And I think that's where a lot of chartists make mistakes, I think, in the bigger context. But I mean, with that said, I mean, there are those periods, like for instance, in the 1970s, where the inflation and the nominal value of those stocks actually made it appear that the stock market was flat, when on a real basis, the stock market lost 90% of its value on a inflation adjusted basis. But there are other periods where Project Zimbabwe, like Cuppy talks about, where equities just keep ripping higher just because of the monetary dilution that's going on. But what's your take on that?
Well, are you sure about the 90% number? It sounds high, but
no, I'm pretty sure it was somewhere near 90% on an inflation-adjusted basis. While the Dow's, no, listen, maybe I'm a fool.
Fact check.
If any of our listeners know the real number, if I'm wrong, please.
I do know that you're correct that for a decade the stock market went sideways, and for that decade there was lots of inflation. So you very well might be correct, Patrick. I'm not.
But
I'm not saying you're wrong. I'm just asking you. But anyways,
I've heard that number, but I didn't do the calculation myself. So if anyone knows the correct number on that, and I'm wrong, so please let us know.
Because you're never wrong. So I do think that you should think about that. If you're asking specifically about how it affects channels, I can't help you with that, because I don't. I think that those things don't matter as much as Patrick thinks. But I do think that when you're thinking about your investment and the alternatives, it's important that you incorporate carry and inflation. And just like when we go back to Alex Gurovich talks about this all the time, how a lot of people will sit there and they'll use a bond yield, and they won't think about the carry that's involved with that, or the fact that you'll get CNH is another one, the renminbi. If you go long the renminbi, it looks like it's gone sideways, but meanwhile it's carrying super positive. So those trades end up being much different. So your real P&L in actual dollars that you spend is different, and that is what's important there.
Right. All right. Next question, Lena.
So last question here. Hello, fellow Montrealer here. Please don't ever stop doing this amazing podcast. First, I'd love to point out that Patrick's laugh at an hour and 30 minutes or so in last week's episode 169 made him sound like an evil French wizard named Gaston.
Okay, right, let's play the tape. Okay. Now, that's Patrick laughing. Now, Lena, you and I have a tape that we think is more important. And when you think of Gaston, what do you think about? I don't think about an evil French wizard. I think about somebody in
Gaston from
Beauty and the Beast.
That's right.
Oh my God.
And so let's see. There you go, Patrick. You sound just like Gaston from Beauty and the Beast.
Oh my God.
Okay,
all right.
Let's get on to the next question.
I need to start working out a little bit more to
look like Gaston.
Yeah.
Second, suppose I believe that the yield curve is going to flatten before a potential Fed pivot. What is the best way for a small retail trader to express the short-term view that the curve will flatten? Third, is there a single publicly available and regularly updated measure of stock market liquidity that retail traders can watch to monitor market conditions?
So I'm going to do the flattening curve one. There used to be an ETF called Flat. It wasn't very successful, and it delisted. Realistically, if you want to bet on the flattening of the curve, the easiest way is to do it through Eurodollar futures. They're not that complicated because they trade on a yield basis as opposed to a price basis. You just do one versus the other. Go back and listen to Alex Manzera. We had him on the show. I think we had him on twice, but I think the second time he talked about how various Eurodollar future spreads,
We should have him
mimic
back.
we should have Alex back. They mimic different parts of the curve. Like if you want to do a 210, then you do the X, like the eighth versus the 32nd Eurodollar future, and that'll approximate. I can't remember all the numbers, but it's there. Alex has it. It sounds scary. It seems complicated. It's not as bad as it seems. It doesn't need a ton of money in there. It does. I know a lot of people hear futures and they imagine crazy stuff, and I think they're really limiting themselves, because I personally love trading fixed income products and fixed income futures. There's a lot of math. It ends up being a different kind of trading, and I enjoy it tremendously, and I encourage others to go do it. And by the way, Patrick, I just want to tell you something. I always got people assumed that I was a fixed income trader, and I was always like, no, I'm actually an equity trader, although I was an equity derivative trader, so there probably was no math. And whenever I write something on my letter that's very bondy, my buddy always says, Kevin, I am an equity trader, Muir, and he always laughs at it. And he says, because he's an equity trader, and they just see all the math and they think, oh no, I'm not going to do it. And I really think they should spend a little time, because it's not as complicated as it sounds. Yes, you equity traders can trade bonds. They're just because they're geeks, the bond traders, doesn't mean that they're that smart, much smarter than you.
There you go. All right. So, Lena, where can people submit their questions? And by the way, we have to say, like, we've started to run out of side effects.
That's right. If you want to get your question answered, include the side effect, because that's we always put those to the top of the pile.
Absolutely, because we need more side effects, and
yes.
So it's really important. Anyway, Lena, where can they submit it?
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
All right, folks, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. We're there every day. Lena gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate and review us on iTunes. You know why. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna. And where can they find you, Kev?
I'm on Twitter at Kevin Muir, and you can check out my letter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. All right, Patrick, you're the only one reviewing.
You know what? I have to say, like, at first it surprised me. Like, it's I guess it's a pale ale, but like I was I don't know why I was expecting to get punched in the face with an IPA kind of taste, but this is
no pale ales aren't like that.
No, but I don't know why. Like, I guess I was expecting something different, and it was actually super light, easy to drink. It's a good beer. I'm gonna give it a 7.8. It's
solid beer.
It's a solid beer for sure.
Okay.
It's a nice brewery right in the center of Lisbon, and certainly a fun place to stop by if you're just looking for a quick pint.
You're gonna be like a regular there, Patrick. They're gonna know you. It's gonna be like
know him.
That's gonna be like Norm when he walks into Cheers and they just start pouring a beer.
Nice. Nice.
All right. Lena, do you have anything new? Any new shows?
Okay, so someone had recommended that we watch something called Love is Blind on Netflix.
Okay.
And, it kept popping up on Netflix, and I was like, what is this? I watched 2 seconds of the intro, and I'm like, nope, I'm out.
Yeah.
And then this friend of ours kept saying, no, like, it's actually worth watching. And I was like, okay, like, we'll give it a shot. Because I'm not a big fan of reality shows, and it's a reality show. Basically, the premise is there's 15 men, 15 women. It's like a blind date, but you don't get to see each other. So you're talking to each other through a wall. And how you get out of it is, at the end of it, if you've made a meaningful connection, you have to propose. And then you get married. And this is happening all within 5 to 6 weeks span. And you think it's ridiculous, but Luke and I've lost 10 plus hours over time. watching this show because it's like crack.
So
And has there been like shocks when they finally see each other?
Oh,
No, they
there's so
haven't
much
done it yet.
drama. So much drama
Wow.
where people are like,
Okay.
oh, I'm in love with you. We're going to get married. And then they see each other and they're like, wait a minute.
the, you know when you tried to tap out like Kramer in the Master of Your Own Domain section, the episode of Seinfeld, where you're like, I'm out?
Okay.
I'm going to tap out faster than Kramer. 52 tomatoes. It's reality show. This is like, Lena, I'm usually like, I'll listen to your stuff and I'll,
No,
and I'll
this is-
consider
this-
it.
this is not
I am
your show
tapping
to
out.
watch,
I
no.
am tapping out way before. This must be a generational thing. Patrick and I are Gen X. You're millennial. This obviously is something I'm never going to do. Patrick, would you listen to the? Would you even try this
Absolutely
show?
not.
No,
yeah.
probably not. Your daughter might like it.
Yeah. I just that sounds
But
terrible.
but funny thing is, there's
I'd
couples
rather
that were actually
watch-
gotten married and they've stayed married from the show.
I'd rather watch Sex in the City reruns for the rest of my life.
I don't
honestly.
know. I don't know.
Honestly, that's how much I don't like reality TV. to
I don't
start with.
usually watch reality TV shows ever. And this person was
I
actually
did like
this person was
Survivor
actually
when I was
Taylor.
back in the day.
It was actually Taylor that recommended, and he was like, "You guys need to watch this." I was like, "Okay, let me watch it." And I was like, "Oh, great! Now I've lost 10 plus hours of my life."
Okay, so now after telling you how uncool you are, I'm going to tell you how cool I am.
All right.
So you know Downton Abbey?
Yeah. Okay. Where is this going?
There's a new Downton Abbey in New York City called the Gilded Age. And I don't know, I like it.
I'm sorry. It's a show.
Yeah, it's called the Gilded Age.
Where is this on?
It's on HBO.
But it's in
I'm
New
kind
York
of
City.
embarrassed. I'm embarrassed.
Oh my gosh.
Oh my goodness! You want to hear the funniest thing? You know how we had Vincent on the show, and he admitted that he likes Emily in Paris,
Did you?
and we thought this was very proud of this. Listen, and Vincent coming out and admitting that is part of the reason I can tell you I like the Gilded Age. It makes it easier for us all to admit these things.
Yes.
And the fact that I like British baking or whatever that show is, I like it. I must admit, I like it. But the funniest part about that is I get this email from Louis Gove, and Vincent's. I hope Louis doesn't mind that I'm saying this. I don't think he will. He says, "Vincent, great interview, a lot of great things to stuff and like that. But I'm disowning you as like as a Frenchman." It was in essence what he said. It was because of Emily in Paris. So I thought that was pretty funny, actually. So Gilded Age is right up there. But listen, my Gilded Age has 79 tomatoes. Your Love is Blind is 52.
Well, this is different genre, though, right? This is like a
Well, no,
period
but-
piece, and that's like a reality show.
Yeah, but still, like, the tomatoes don't lie. Well, they lie every now and then. What did we decide they lie on? I can't remember. We've
I
decided that
can't
there are some things that the tomatoes are wrong about.
But you know, truth is stranger than fiction. So
That's
reality
true.
shows
I
sometimes-
can't.
There's
I don't
some.
know.
There's some. Like we skipped a few, or we fast forwarded a few episodes here and there, but there's some interesting points. Just gonna say that for our.
Well, anyways, you
millennial
should try
listeners.
that. If you're looking for something, Lena, the Gilded Age isn't bad though. Do you like Downton Abbey?
Yeah, I watched. I think the first 2 seasons.
It's kind of like it's in New York City, and they don't bother with the help as much.
Nope.
They're like, no, none of this downstairs shit. We're doing it all upstairs. And what's interesting is that it's New York in the late 1800s. So
Isn't this like the same time frame as like
no,
Gangs of New
actually,
York?
Downton Abbey starts in 1910, I believe.
Oh.
Just as because the first episode, the Titanic sinks. So whatever that is, 1911, I'm not sure, but it's around then.
I don't know.
Anyways, there you go. One for the millennials, one for the Gen X, boomer / gold,
Nice.
whatever.
Oh, by the way, if
And
anybody's
you know
looking
what
for,
I watched? Nothing.
Oh.
Yeah, of course.
If anybody's looking for Alex Manzera episode, it's episode 105.
There we go.
But we should have him back. We should.
Oh, we should, yeah. Yeah.
You know,
no,
because I think this is an amazing time in the markets to kind of size up what's going on in the rates markets.
well, we would have him back, but you two are busy taking time off traveling, so like we have limited slots.
Nice. I'm going to be working from Playa del Carmen for a month.
Yeah.
It's a tough life, right?
It is a tough life. And
But
Lena,
by the way, if any of our listeners are going to be down there, there could be a little huddle piss up if anyone wants to.
at
reach out.
Senior Frogs.
Is it?
Well, that's
All
where you
right.
got to go. Don't you know about Senior Frogs?
Oh, Senior Frogs, you mean?
Yeah, am I saying it
I
wrong?
thought you said senior frogs. I'm like, what are senior frogs?
That's where old guys like us go.
I've never been, so like, is
Seriously?
that where should I go?
Oh my God, Patrick, what are you? Were you never young?
No, I was never young.
like
I was always old.
like you've really never been.
No.
Oh, you got to go.
Senior frogs.
Lena, you've never been either. No, you might have never been to Mexico before.
I've
right?
been to Mexico, but I've never been to Senior Frogs.
Oh, I can't believe this. You guys, okay, listen. Anybody that's there, make sure you insist that Patrick and Lena have a Market Huddle meetup, piss up, at Senior Frogs. By the way, isn't it hilarious how you're watching the British? You know how what's his face, Bojo there, Boris Johnson's getting in trouble for having all these parties, and they literally call them piss ups on the news.
Oh,
It's awesome. I love the British. They're awesome.
Is that
They're
like
literally
accepted news language?
yeah. Well, I don't know if it's technically correct news language and if they're using BBC English, but I definitely have heard it like Arsena written. Maybe it's actually what he called it.
Oh,
But anyways, piss up. It's like it's right up there.
all right.
Nice.
We
Yeah.
got something right.
Yeah, we did. Okay, well, we'll let you guys go.
All right.
Have a great evening, everyone, and have a
Yeah.
great couple weeks.
Yeah, we'll
Everyone
see you
stay
all
safe.
back here in a couple weeks.
Take care. Bye-bye.
All right, cheers, everyone.